Uh, Welcome back to our channel. Now we are discussing on an important topic. Can charitable trust give interest-free loans? Now we'll discuss on ITAT Chandigarh verdict, the latest 15th January 2025. Can surplus funds be advanced as interest-free loans? So the ITAT Chandigarh ruling in the matter of ACIT versus KC Social Welfare Trust provides a critical interpretation of Section 11, Section 12, and Section 13, including Clause 3 of Section 13, which deals with prohibited benefits to related persons. Here, the legal framework applicable to charitable institutions. Section 11, income from property held for charitable purposes. Income is exempt if it is applied or accumulated for charitable or religious purposes. Income is exempt if it is applied or accumulated for charitable or religious purposes. And minimum 85% of income must be applied in the same year. The balance can be accumulated under Section 11(2). If not applied or accumulated, in accordance with the prescribed condition, tax is levied. Now we will see Section 12, that is voluntary contributions. Voluntary contributions received with a specific direction, example towards corpus, are treated as the income eligible for exemption under Section 11. Now we'll discuss Section 13, that is loss of exemption. Section 13(1)(c), if income is applied for the benefit of specified persons defined under Section 13(3), exemption under Section 11 and 12 lost to that portion, to that extent. Section 13 talks about the loss of exemption. Section 13(1)(d), read with Section 11(5), investments must be in permitted modes. Non-compliance results in denial of exemption. Violation doesn't always cancel the entire exemption, only to the extent of the violation. We'll see the background of the case. KC Social Welfare Trust is a registered society running multiple educational institutions, and it is enjoying registration under Section 12A and recognition under Section 1023(c)(6). In earlier years, the trust was granted exemption under Section 11 and Section 12 without any objection. Now, AO's scrutiny and additions for the financial year 2014 and 15, scrutiny under Section 143(2) was initiated. AO noted interest-free advances, 37.57 crore given to the group entities, related entities, that interest-free advance is given. So concluded that violated Section 13(1)(c) and 13(1)(d), as some recipients were allegedly related persons. Then notional interest of rupees 4.5 crore was calculated and added as the income. And second addition of rupees 12,79,000, 12.79 lakh was made on grounds that it was unutilized surplus over expenses and hence taxable. So AO's key argument, the trust violated the fiduciary duty by using funds for non-charitable purpose, and claimed that benefit under Section 11 and 12 was no longer available. These are AO's key argument. Assessed the trust as an AOP, association of persons, instead of charitable institution. Now we'll see Commission of Income Tax Appeals, partial relief, and Department's appeal, CIT A, deleted the notional interest in appeal deleted the notional interest addition and observing that no real income had occurred. There was no specific provision to tax hypothetical or assumed income. So, however, did not give detailed analysis on the charitable application of funds. So, revenue challenged deletion, arguing that loans to related parties violate section 11.5, 13.1c, and 13.1d. Hence, entire exemption under section 11 should be denied. This is Commission of Income Tax appeals, partial exemption, and departments appeal. Then we will see the ITAT's analytical observation. Charitable trusts hold funds in fiduciary capacity. So charitable institutions do not hold surplus funds in a proprietary sense. And funds are held in trust for the beneficiaries or objectives of the institution. Therefore, such funds cannot be used like business profits where discretion exists post-taxation. So these are all ITAT's analytical observations, and surplus is not equal to free of discretionary use. Surplus funds must be applied for charitable purposes or invested under section 11.5. So if funds are advanced to related entities without sufficient justification or due process, it amounts to misapplication. So the important classification by Tribunal, exemption under section 11 and 12 cannot be denied completely for minor violations. Only the income up to the age for the benefit of prohibited persons under section 13.3 can be taxed. Notional income, example, imputed interest cannot be taxed unless there is a charging section. Fiduciary nature of surplus funds, unlike business houses, trusts are custodians, not beneficiaries of their income. So trust cannot give gifts, trust cannot give donations or interest-free loans unless it aligns with their objectives. So even where funds are advanced, adequate documentation, board approval, and clarity purpose must be ensured. So the technical deficiency of AO's assessment was AO failed to prove direct nexus between borrowed funds and interest-free advances, justify 12% of interest rate assumption, explain why similar transactions in prior years were accepted. So options of day-wise interest calculation question. AO also ignored that more than 99% of gross receipts were applied towards charitable purposes. So the tribunal's verdict and directions will see. Tribunal set aside both the Commission of Income Tax Appeals and AO's order and held that AO should re-examine each advance, determine if there were two related parties and whether real benefit occurred. Not all funds advanced by the trust can be automatically deemed to violate Section 13. Directed AO to not deny exemption under Section 11 entirely, but only disallow undue benefit, if any, under Section 13.3, that is benefit given to related persons. So the practical takeaways here is surplus funds must be applied for accumulated per Section 11. Any loan or advance to related parties should be backed by proper documentation in line with the trust objectives and interest bearing unless justified. So trust must avoid intermining and intermingling educational, real estate, or hospitality funds without transparency. So trust must avoid intermingling educational, real estate, hospitality funds without transparency. Even one-off lapses will not necessarily cost entire exemption, only proportionate taxation applies. So the concluding remarks is that the ITAT Chandigarh ruling reaffirms that tax authorities must apply Section 13, logically and proportionately. It also highlights the duty of the charitable organizations to preserve fiduciary discipline. An extremely valuable case. This is a very example case for NGOs, Section 8 companies, educational societies, and even for advisors. We have two channels, RR Corporates and RR Legal Talks. Please do subscribe and hit the bell icon so that you will not miss any of the latest updates. Thank you.